Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. The global stock rally stalls, with Nvidia leading a sharp sell-off in heavyweight tech shares. Futures indicate further declines. Treasury Secretary Scott Bessent signals the US is satisfied with the current tariff setup with China, a sign perhaps the administration is looking to maintain calm with its economic rival. And UK inflation on deck. Will bring you the latest CPI numbers as they cross the terminal.
OK, let's talk about these markets. It's Wednesday. It is the 20th. Do you buy the dip? Not yet, would seem to be the indications from the futures picture. Euro Stoxx futures are lower. NASDAQ futures are still lower. That CPI data Anna's just been talking about dropping onto the screens right now. I'm trying to watch the pound to see if there's a reaction that I can glean what the data is telling me. I'll bring you that data in just a moment. And can you have a dovish Kiwi? Well, that's certainly what we've had overnight out of New Zealand. The Reserve Bank, very dovish. And as you can see, a big reaction in the currency as a result of that. Lots to talk about this Wednesday morning. The countdown to the opening trade starts right now. Right, here we go. Hot economic data out of the UK. The inflation numbers are hot, and that is going to pose a problem for the Bank of England. Certainly the doves over at the BOE. CPI year-on-year rises to 3.8% from 3.6. That is the headline number. That is well above the survey. Well, not well above the survey. It's 0.1 above the survey of 3.7. The services number, though, is where the shock maybe comes through. That has now risen to 5%, up from 4.7. The expectation there, 4.8, and there we are definitely above where the Bank of England anticipated we would be at this point. So a hot reading out of the UK, and it looks like sterling's risen a bit on the back of this. I wouldn't say a lot on the back of this. A little bit of reaction to the upside. Yeah, so the number is hot compared to estimates, as you set out there, Guy, and certainly that services number at 5%, that's just got that sticker shock, hasn't it, when it starts with a 5, for sure. But interesting that I think the Bank of England had an estimate themselves that was slightly ahead of where the market was, so I think 3.8% is broadly in line with where they saw it. But of course, we have heard from the Bank of England pretty recently, just earlier on this month. We got that hawkish cut from them, and they saw inflation peaking at 4% in the month of September. That has been one of the things that has led to lots of conversations about whether we are going to get any further rate cutting from the Bank of England, of course. I think Bloomberg Economics has another cut in November, but they acknowledge that there are a lot of questions around that kind of move right now. Been to the grocery store recently? Quite expensive. Certainly the food story is something that we're focusing on. And you talk about sticker shock. People feel that on a daily basis, and it feels like inflation is still a problem in this country, certainly when it comes to the basics of what a lot of people rely on. Yeah. The bank had 4.8 for services. We've got 5. Right, OK, so on the services side, yes, absolutely. It's a higher number than expected for them then. We're ahead of where we... And the services is the bulk of the economy, so that is maybe slightly concerning. So, yeah, we'll see what Bailey has to say later on this week. He's now got the data. What does he say at Jackson Hole? What does he do in terms of guiding expectations? Obviously, we're going to watch for Powell, but Bailey's speech could be quite interesting. And yields have been on the rise, as we talked about quite a lot yesterday, and there's a lot of global dynamics behind that. But then in the UK context, is this because we're pricing out cuts on interest rates, because we're acknowledging that this inflation story is a little bit stickier than had been expected? Poses a problem for the Chancellor as well. Yes. So debt costs become even more of a problem, which means she's going to have to raise more money, and you wonder where she's going to do that. There are a lot of kites being flown at the moment around property and wealth taxes, which are causing consternation, I have to say, certainly here in the City of London and across the South East. It's going to be interesting to see how the politics reacts to that. Yeah, absolutely. So we'll watch the property story, we'll watch the tax story here in the UK as it evolves as we get further into the autumn and budget season. Let's talk about tech and the sell-off that we saw in global tech recently over the last 24 hours. So this is relevant for looking back, but also looking forward, because US futures are negative, down by 0.5% right now. The NASDAQ was down by 1.4% yesterday, the MAG 7 down by 1.7%. And just putting this in context, we had a sell-off on August 1st, didn't we? But that was around the payrolls number. Yesterday's sell-off for big tech seems to be around nothing, or around not much. Ongoing concern, surely, about valuations, about whether the AI theme has run its course. Some people are pointing towards this a story that Fortune had, I think, that talked about AI and whether it's really delivering as much as we think it is. But there wasn't a huge data point. We're waiting for Nvidia numbers, and that's going to be really important next week. I wonder whether this is a Treasury story. whether actually the ongoing tick higher and the steepening of the curve is certainly something that could feed back into tech valuations. If you're of a positive disposition, this is fantastic. Nvidia numbers are coming. They're going to be great. This is an opportunity to buy in at a cheaper price. You buy the dip, see what happens. We're not there yet, certainly in terms of Nasdaq pricing this morning, which has firmed a little bit, but not much.
And of course it is August, volumes are really low.
Yep.
It's the Markets Live blog asking, saying you can't tell really in a month like August, at a time like this, when volumes are what they are, you can't tell if this is just a sort of summer squall or the start of a real storm, and both courses could open themselves up as we head into the rest of the year.
I have another reason, which is Torsten Slock over at Apollo posted a note yesterday basically saying we are in late 98 in terms of the timing, if you were to put this in dot-com bubble kind of territory.
And again, if you're an optimist, that's another 2 years.
Precisely. Well, a year and a bit. So March 2000 was when the sell-off came.
Yeah.
But he's got this love and overlay chart. He had a fantastic overlay chart yesterday. Anyway, let's talk about Scott Bessent. Always a fun topic. The Treasury Secretary apparently is currently satisfied with the situation with China, which is unsurprising considering it's generating huge amounts of revenue for the Treasury, given what the tariff situation is at the moment. It's interesting. So what is the objective of the tariff regime? Is it to raise revenue? Bessent seemed really happy with that yesterday. We're making loads of money off the Chinese. Thank you very much. Great stuff. Carry on. Yeah. Or is it regarding rebalancing? Didn't talk about that quite as much. Is it about fentanyl? Didn't talk about that quite as much as well. Just quite likes the money.
Yes. Is it about both? And certainly on the China side, they seem to be happy with the amount of money that's coming in on that front. It's interesting, I've been away for a couple of weeks, and I was thinking, surely we've had that meeting between Xi and Trump, haven't we? Have I missed that? But no, we're still not only still waiting, we don't know if it will happen, but we have heard from Marco Rubio. He says that that is still due. And some people are drawing a line between the tone we're getting from Bessent and others who are quite satisfied with the relationship with China, the tariff truce extended to November, and saying that kind of positive language or contented language is designed to try and get that meeting to take place.
Maybe. But Trump keeps messing with it, keeps announcing new tariffs, going to upset the Chinese as a result of that. So I think that's going to be interesting. It was interesting Home Depot's numbers yesterday. I'm waiting for Walmart to see what they say. Home Depot indicating the tariff hit is yet to come in the United States, i.e. the inventory story has cushioned them. India is still a target, which is interesting as well, which pushes China and India together, which again kind of creates something for that potential Xi meeting to talk about. And do you see the Japanese export numbers this morning? Down really hard on the back of tariffs. That hit coming. They have a 15% deal, and that's still not done.
Yes.
So everybody in some ways are in the Chinese boat right now, because even if you've got a deal, it hasn't been enacted. Yeah. So you're still in this kind of limbo land that the Chinese are in. Yeah,
there's got to be a long lead time, hasn't there, between these things being announced at top level by Trump and others, between that and actually signing on the dotted line. Interesting, our reporting, you talk about India, our reporting suggesting that India has, just in the last couple of days, gone back to buying Russian oil after a couple of days of a lull, as if these words from the US administration not scratching the sides.
Some would argue that they don't really have a choice, and that's what they need to do. Melanie Baker's going to join us very shortly. She's going to be talking about the CPI data that's just dropped onto our screens. The pound not reacting, actually, very much. Richard Windsor's going to join us from Radio Free Mobile to talk about Intel and what is happening with this tech sell-off. We'll also have that conversation with Mark Andersen, co-head of Global Asset Allocation over at UBS Wealth Management. He's going to join us at circa 8 o'clock, just after the market open. And Mike Parra, the CEO of DHL Express Europe, is going to be joining us. What is the story with tariffs? What are we seeing? How's it affecting the consumer? There's a lot going on in his world right now. Yeah, there absolutely is. And in terms of the data points, we didn't have much to talk about yesterday when it comes to macro data, but we have a little bit more today. We've already had the UK CPI print. We've got Euro area CPI at 10 a.m. UK time. Then we'll get target earnings. I may or may not have added to their earnings over my summer trip to the United States. So target earnings out at 2:30 p.m. UK time. We'll watch for those. Guy's been referencing the importance of the US consumer, of course. The Fed's Waller is speaking. I think we get Bostic speaking as well. We have FOMC minutes a little bit later on today. Is all of that going to be overshadowed by the fact that we're waiting for Jackson Hole? Yes. So, the minutes are interesting in themselves, I suppose, but always backward looking. And we're going to hear from the Fed so soon. I think the minutes are more interesting than they normally are, in as much as I think you increasingly have a series of very divided central banks around the world. You saw that in New Zealand overnight. You've got that with the Bank of England right now. You've got that to a certain extent with the Fed. And will these minutes highlight that division that we are increasingly seeing? Where does the centre of gravity lie? Where does Powell lie on the spectrum in terms of his views on where we need to go with interest rates next? Now, clearly, we're going to get some clarity Friday, but a bit more detail setting the stage going into that Friday speech, I think, will be interesting.
Yeah. What might be less interesting is Eurozone inflation. I mentioned that aggregate number is out later on today. It's a final reading. Yeah. It's expected to be confirmed at 2%.
Perfect.
This is what central bankers dream of, I suppose, although they shouldn't perhaps say so, job done.
The debate that's increasingly growing into that Powell speech is whether or not Powell is going to address the issue of the symmetrical target. And whether or not he goes from having the symmetrical target, which we've had over the last few years, i.e. if you spend 3 years above target, you spend 3 years below target, which gives you a symmetrical. Whether they get rid of that is going to be really interesting in how that sets the tone in terms of interest rates going forward from here and where they are set. That's one of the subjects we're going to be hearing about on Friday. The labour market is, of course, front and centre. What else do you need to know this morning? Talking of the labour market, Meta is to reorganise its AI team again. The company is splitting its artificial intelligence division into 4 distinct teams to better capitalise on the expensive new talent it has recently acquired. An internal memo from the company's chief AI officer said the new structure, known as Meta Superintelligence Labs, is aimed at accelerating the company's pursuit of so-called superintelligence. Bloomberg is told there will be no layoffs as part of the reorganisation. A package of security guarantees for Ukraine is now taking shape, with European leaders weighing sending troops to the country to backstop a potential peace deal. Ukraine's allies are hoping to strengthen Kyiv's position ahead of a potential meeting between Presidents Putin and Zelensky. US Special Envoy Steve Witkoff spoke to Fox News on the US efforts to broker this peace deal.
It's our job to bring the parties together, to narrow the issues, and that's what President Trump does better than anybody. He's got a real sense. I mean, he's got a real sense of what it's going to take for Ukraine to meet in the middle and to move the Russians.
History teaches us that details matter, and specifics of the US security support remain unclear at this point. Thousands of firefighters, aided by soldiers and water-bombing aircraft, continue to tackle wildfires across Spain. The fires have killed 4 people and burned an area, get this, twice the size of London. Temperatures have begun to drop, but still Spain is confronting one of its most destructive wildfire seasons in recent decades. And there's talk now that this could start to impact the tourism industry. You've also got the over-tourism issue and whether or not this starts to affect economic numbers out of Spain. Obviously, we won't see that just yet, but we could see that in the data over the next few months.
Yeah, something we spoke to the Foreign Minister about just yesterday, in fact, on this programme. Coming up then, we'll get back to the tech theme. Intel's sudden rebound sends its valuations to dot-com level highs. More on the share turnaround. Is it sustainable? What does it tell us about the tech sector more broadly? We'll have that conversation later. Plus, shares in the Chinese toy maker Mart soared on the back of strong sales of its Labubu dolls. No, I've not been buying any of those. I'm not guilty on that particular front. We discussed the growing hype around the company. Up next, we dive deeper into the latest UK inflation data, more on what the print signals for the Bank of England's next move. And if you want to get involved in any of the conversations around the desk, please do. IB plus BBTV Go. That's the function that you can use to get in touch with the team. This is Bloomberg.
Well, right now I'm committed to doing the job that I have, and we've really hit the ground running with our request for information on check fraud and other payments fraud, with the SLR proposal that we just put out, the LFI rating system. We're taking a really hard look at our supervisory components and across our reserve banks, as well as at the board, to ensure that we're focused on material financial risk. So I have a big agenda. We're moving through it quickly. Obviously, we need to get the capital proposals completed in the near future. But, you know, I'm really focused on the job that I'm doing, and I'm grateful to the President for appointing me and the Senate for confirming me to this role.
See what happens next. Michelle Bowman, speaking of Bloomberg exclusively. We'll have more, obviously, Fed speak coming over the next few days. The US Federal Reserve's top bank watchdog. It's an interesting conversation, but where we go next with her, I think, is the more interesting conversation. Let's talk about what we saw yesterday. We're scratching our heads trying to work out why the tech sell-off happened yesterday. Is it repositioning ahead of Jerome Powell's Jackson Hole speech Friday? That's one argument. There are others. Look at the bond market, maybe for another one. Valerie's here to answer some of our questions. Val.
Oh, man, I'll try. But yes, yesterday's repositioning out of tech really did make people scratch their heads on just what was the catalyst. No clear catalyst in the session yesterday, maybe just some new jitters about what we could possibly hear from Jerome Powell's Jackson Hole speech on Friday afternoon. What the market really wants to hear is that dovish pivot, expressing some concerns about the labor market, maybe in some way subtly giving the green flag to that September rate cut and possibly more to follow. There could be a hawkish scenario, and this was written by our own Anna Wong on the Bloomberg terminal. She's our U.S. economist, saying that she thinks that Jerome Powell could sound hawkish, and the way he could do that was by dropping this flexible inflation average targeting framework. Now, this is some framework that was very useful when inflation was below target and the Fed wanted a reason not to continue easing. It's kind of creating problems now that inflation is above target. And that could be something very subtle that Jerome Powell could do to sound hawkish. He could also just sound neither dovish nor hawkish, stress data dependence. We do have another CPI and another NFP print before the Fed convenes again in mid-September. But take a look at the price action that we've seen in the front end. Those two-year yields have held on to most of their rally from that soft NFP report on the 1st of August. We have maybe come back just a smudge after that PPI report, but we're continuing to see options trades on the front end targeting a 50 basis point move in September. So clearly some traders out there think that there is good risk reward to bet on this dovish pivot on Friday from Jerome Powell. But remember, the Fed is also under some political pressure. We just had a true social out from the president overnight. In his mind, there is no inflation, and every sign is pointing to a major rate cut. So I guess from the Trump administration, they're penciling in 50 in September.
Change the Overton window, change the language, change the discussion. That certainly seems to be the president's strategy right now and continues to be into that speech Friday. The Bank of England certainly has an inflation issue to deal with. We've just seen headline inflation come in above expectations. Services inflation is now running at circa 5% in this country. The breakdown's quite interesting. Number of things stand out to me, one of which the price of jam has gone up really quite sharply. I'm assuming you include marmalade in this, which is, to my mind, very serious.
This is a controversial.
If you're talking marmalade, then life starts to get quite concerning. Passenger transport by air is one area that also stands out. The prior number, the June number, 0.5. This number, 15.5. So that's a big contributing factor into what we're seeing in terms of the services numbers. Melanie Baker, senior economist at Royal London Asset Management, joining us now around the table to discuss. Is this the kind of data that will force the Bank of England to hold, basically, through the rest of this year into 2026? Can I take out November as a potential cut from the BOE, given what the numbers I'm looking at on the screen right now look like?
I wouldn't take it out yet. I think,
right.
I think it's uncomfortable, right, that inflation just keeps rising. That's not the greatest backdrop for a central bank. And remember, the Bank of England are already expecting inflation to rise further. I'm expecting that to peak in September. They have a 4% number. Remember, so that's kind of in there. I think for the bank, a lot of it's going to come down to, okay, what are the drivers of that inflation number? And today's number, I think a lot of the supply seems to be airfares. That's a really volatile component.
Sure.
It's affected by timing of school holidays and all sorts. So I think they might put that a little bit to one side, and they'll look instead at the labour market, the trajectory for wages. So I think, in terms of upcoming data, I wouldn't rule November out.
Are these the kinds of numbers that will allow Labour, I'm not talking about the Labour government, the Labour to say, basically, we need a pay rise? Because at the moment, the labour market appears to be weakening, and therefore you take the wage risk out of the inflation risk. These are high numbers, and people are looking at jam prices and marmalade prices and things like that at the grocery store and seeing there is sticker shock there. Things are going up really quickly still, and I'm just wondering whether that does feed through still into wage demands.
I think so, yes. And things like the energy bills especially as well. Those very visible prices that consumers see. So, yes, and that's one of those things that the Bank of England are worried about, right? That's why they keep talking about inflation persistence. Does it feed through wages, through wage demands, into more persistent inflation? So we're watching that very carefully. Because at the moment, in terms of the labour market, what we can see is that it does look like it is deteriorating. It is weakening. As you said, it does take some of the pressure off, I think. And firms are still saying they're expecting pay settlements to come down next year.
But you don't see, good morning to you, Melanie, you don't see this piece of data as saying, right, that's it, no more cuts then from the Bank of England, even with the services inflation rate that starts with a 5, and services is so much of the UK economy.
Services problem, services is sticky, but the bank, remember, they've been moving away from just looking at the overall services inflation number and trying to dig down to core services. And if a lot of that services number is actually about airfares today, that won't be in there, that isn't in their kind of core services number. So it might not look quite as bad from that pure services perspective in that sense.
Yeah, help us understand a little more about what these services inflation numbers tell us then, because yes, I received an email from one viewer who was saying, that airfares. If it's airfares, this is demand driven. Is the suggestion that he makes. And if we look at the things that did lift the inflation rate, Guy's been talking about some of the specifics. Airfares, also hotels. Does that sounds demand driven, doesn't it? That sounds like.
You have to be, again, very careful with airfares. So we know there are differences in terms of the timing of the collection dates related to school holidays this year.
Sure.
That's in the ONS statement. So I don't think we can say that bit at least is demand-led. Hotels, again, you get very funny effects. We've had it before where there have been key concerts in certain cities that have impacted.
Is it Oasis? Is that what we need to throw in here?
I haven't seen I haven't seen it yet, but it might be. So you have to be a little bit careful with those numbers and look at the overall pattern.
I'm trying to find I'm trying to find the Oasis line in the chocolate running at 17%.
Is that all the Dubai frenzy?
That maybe it is, yeah. But chocolate prices, another key input into my household, certainly seems to be running at a fairly high level at the moment. If you take a step back and think about this from the government's point of view, inflation is running high, yields are high, servicing costs are high, particularly given the kind of A, because we've got a lot of linkers in the mix, and B, because we've got a lot of front end. How does this kind of data change the calculation, do you think, for Rachel Reeves? It just points to the fact that she is going to have to raise taxes. The hole is going to be bigger, that she's going to have to be more creative. Like the debate at the moment is about wealth taxes and how you tax property and how you change maybe the mix there. Should we assume a higher tax burden? And what are the implications of that for growth in the UK economy?
Yeah, I mean, the economic backdrop isn't particularly helpful for the fiscal finances right now. That's absolutely fair. And of course, we do see pay growth that can be through income tax receipts, but generally, no, it's not been helpful. The bigger things, though, have been the watering down of the welfare bill reforms. And a lot of UK analysts, when you talk to them, are also worried or assuming that the OBR are going to revise their productivity assumptions. And that can make a really big difference to the fiscal projections. That could be instead what gets us to those possibly needed tax increases. And it does look, as you say, like they're considering quite a number.
Yeah, it's so confusing, all of the various reports around property. We'll see what actually falls into place on that front. You mentioned data, some of the ONS data and the detail there. How concerned are you about the data at the moment, Melanie, out of the UK? We've already got concerns about the Labour report, about GDP, inflation and trade, about the quality of the data, I mean. And then just this week we heard that retail sales data is being delayed by 2 weeks to do some final checks. And, I mean, as an economist, data is your... You need this stuff.
Rubbish in, rubbish out.
I'd love everything to be perfect. What I am happy about, at least, is the ONS being very open and transparent about this. They're looking at things, they're trying to improve things. That to me is a positive rather than a negative. But yes, obviously, I prefer the problems not to be there in the first place. And it just reinforces you need to look at a whole range of data, from official data and survey data as well.
Okay.
I found the Oasis line.
Excellent.
It's gone from 0.4 to 5.7.
Specifically attributed to...
No. Cinemas, theatres and concerts.
There we are. Thank you very much. Well done, guys. That's excellent digging. Melanie Baker, Senior Economist at Royal London Asset Management. Thank you very much for joining us. Coming up on the programme, we'll talk big tech. This is Bloomberg. Welcome back, everybody. This is the opening trade. It is Wednesday, the 20th of August. Markets have a very August feel to them. Certainly, we saw that with regards to US equities and tech trading yesterday. US stocks weaker, tech stocks in particular weaker, but on low volumes, as is typical for this time of year. And there's not a huge amount of, we'll get into this conversation shortly, there's not a huge amount of new news flow around tech, but certainly something is weighing on sentiment there. We've seen that through the US session and into the Asia session, and we are expecting some weakness here in Europe as well. So Euro Stoxx 50 futures down by 0.6%. Let's have a look at where we are on bond markets. Of course, we'll wait another half hour to see how the gilt market opens, and that could be interesting after we saw the pound pick up on the back of the slightly hotter than expected inflation print that we just got from the UK. This is the picture then that we have around bond markets around Europe as we continue to focus on the long end yields higher story. Today we see something a little bit different. Certainly at the 10-year, we see those yields coming down just a touch this morning. Guy?
Just when you thought it was getting really boring out there and calm and like volatility was really low, take a look at the VIX. We get some action. Now, this week was always going to deliver some action, but maybe we thought it was going to come in the back of the week. We're trying to struggle. We're trying to find a catalyst to the sell-off we saw yesterday, because the calm cracked. Big tell-off, big tech sold off. Big tell-off? Maybe that actually is the better way of thinking about it. You have a big reliance in the US markets in terms of the performance you are seeing from the Mag 7, from this handful of big tech stocks. In Asia, SoftBank shares fell for a second day. Concerns over its investment in Intel continue to weigh, though Intel has had a very good run recently. Tom McKenzie tracking all of this, of course. And it's here to provide answers as to why we saw the sell-off yesterday.
I'll be ticked off if I don't provide those answers.
Well, precisely.
It feels.
Told off.
Told off,
yeah.
Told off, ticked off. Yeah. Well, equity investors, with exposure to tech, may be feeling a little ticked off right now. All this is obviously an opportunity.
Precisely.
To buy, given the upside we've seen since April. So what is behind the sell-off that we saw yesterday? Nasdaq 100 closing down 1.4%. Nvidia falling 3.5%. Palantir falling more than 9%. That's the best performing stock.
It has had such an amazing run.
Still up about 120% year to date. Palantir. Interestingly, on Palantir, the short interest has increased. If you do the SI function on the terminal, you can see there's been a bit of a build-out in terms of short interest on Palantir, bit of short interest build-out on Meta as well. So what led to yesterday's move? Probably a combination of things. Is it the valuation story? Is it the concentration risks that John Authors outlined in his opinion piece this time yesterday ahead of the sell-off, pointing out that about 2% of the companies in the S&P 500 account for about 40% of the value? Is it just the momentum that we've seen since April running out of steam? Or is it a bit of profit taking ahead of Jay Powell's speech? Because these are companies that are not capex light anymore, so interest rates do matter.
So, but yields have been ticking higher, so maybe that maybe actually it's the bond market leading this story.
Yes, you were mentioning that at the top of the programme. We're waiting for Nvidia numbers next week.
Yeah.
It feels like quite a long time to wait, if that's what we're waiting. Of course, get Jackson Hole before then. That could set the direction. I was interested, some of the Markets Live blog drawing a link between what we're seeing in crypto as well, where crypto is weakening into Jackson Hole, and suggesting that, there's some overlap. If you do a Venn diagram of the people who are interested in crypto and those who are interested in Nvidia, there is some overlap between the two. And Nvidia has been weak, crypto is weak, as if the retail camp has maybe lost its enthusiasm, or is waiting perhaps just for those Nvidia numbers next week.
And Paul Dobson from our MLive team was pointing out this morning there is data to suggest that historically at this time of the year the retail investor in the US does take a bit of a back seat for various reasons, so they're not at play as much as you would expect in other times of the year. Nvidia is going to be so central, isn't it, as it has been, of course, for the last 2 years, in terms of the earnings story next Wednesday that dropped. The geopolitics are back front and centre. So the Reuters report yesterday that they're looking at designing a new, more powerful chip for the Chinese market. It is yet to be approved by the US. We know, of course, that under this new agreement, they can sell the H20 chip into China if they give 15% of their revenues to the US Treasury. So geopolitics remains a potential risk for Nvidia, but of course, given where it sits and given its weighting, the market is likely to, and we've seen this, move on whether or not those numbers come in line and meet those expectations that, of course, investors have.
I mean, politics just such an influence, such a force behind what these companies can and can't do right now, that it's quite fascinating to watch the way that has changed. Tom, thank you very much. Bloomberg Daybreak anchor Tom McKenzie with the latest on the broader tech sell-off that we have seen of late. Now, one tech company that was not hit yesterday is Intel. Shares in the chipmaker rallying 28% this month, adding about $24 billion in market value. This comes after reports of a potential US government equity stake and a $2 billion investment from SoftBank. We talked about both of those things a lot yesterday. Now, our next guest says he wouldn't buy Intel stock at any price, so he's not convinced. Let's speak to Richard Windsor, founder and owner of Radio Free Mobile and regular contributor on this programme and on the network. Richard, great to have you with us. Thank you for joining us. So you're not, well, it's not enough for you, the fact that SoftBank is interested in Intel, the US government might be interested in taking a stake in Intel. Neither of those things are convincing enough for you to buy Intel. Why is that?
Well, it's fairly simple, because if you actually look at what is at the root of Intel's problems, effectively Intel has been facing two choices over the last 5 years or so. One of them is to invest really hard, catch up with it, TSMC, and regain its crown. The other effectively is to break the company up into separate pieces, maybe sell them off. And the problem is, both of those are valid choices. The problem is that the current management and the board of Intel is effectively chosen neither of them. And so the company is currently sitting in a strategic quandary. You add that to the fact that its core intellectual property looks almost obsolete these days, and its competitors are circling the waters and taking massive bites out of it. I don't really see how a cash injection from the federal government or SoftBank is going to fix that situation. And so it's not until I actually see Intel make a real decision in terms of where it's going to go that there is actually a possibility of a recovery.
Yeah, Richard, how do you think about the role of the US government in businesses like this? I mean, we don't know yet whether they will take a stake, but they're talking about turning some of the grant funding that this business Intel has received under the CHIPS Act, turning that into an equity stake. How would you think about US government involvement like that in a US chip company?
I think this is really all about ensuring that there is advanced manufacturing in the United States. If you look at the geopolitical situation, virtually 100% of advanced chip manufacturing is in Taiwan. The rest of it is in South Korea, and all of that is effectively in China's backyard, and that creates a very uncomfortable geopolitical situation. So that from a US investment perspective, the federal government will be looking at this and saying, we can't afford for Intel to go away. We must make sure that the factories that it's building, the factories that it has, remain in the United States and remain open. And I think that's really what the focus of that is. Now, whether that Intel remains as Intel or the factories become owned by someone else, I don't know. But from the outlook of the stock, the shares themselves, having the federal government in there doesn't guarantee a turnaround, in my opinion.
Richard, morning, it's Guy. I haven't asked you this question for a long time. Tech valuations. Where are we? What do you, broad brush, what do you think right now? When you turn on and look at the data that you're seeing at the moment in terms of the numbers we're getting, does the business case justify the valuation?
In some cases, yes. In some cases, no, Guy. If you look at Google, for example, or Alphabet, you can quite easily justify the valuation of the stock. I mean, the PE is somewhere in the low to mid 20s, depending on where the stock is trading. And from that perspective, and the growth outlook and its position in artificial intelligence, autonomous driving, and all of the other assets that it have, is not unreasonable. And if you flip to the other end of the spectrum, and you look at a stock like Palantir, which I think has the highest PE multiple in the entirety of the US market, it's much more difficult to make that valuation argument. So I look at this at the moment in terms of the market. I think it's a question of selecting the stocks that you want to own. I think generally, valuations are extremely high, but it's really of the Mag 7, as they call them. And if you look at the rest of the market, it's really not that expensive.
What would change the narrative here? I spent half my time talking about kind of the macro forces that are driving what is going on in the world, the Fed, etc., and what's happening with yields and whether or not we get a recession or not. And the other half just talking about this unstoppable force that is AI spending and data center spending and everything that goes around. And I sometimes wonder how interrelated these two topics are and what the overlap is on the Venn diagram. Would a recession actually slow down AI spending? Would we see an effect into the tech space? How immune is the tech space from the wider macro story? What's your view on that?
That's a really great question. At the moment, the macro environment, certainly outside of North America, has not been particularly great, but that hasn't stopped the AI spending. So at the moment, the two are completely unrelated. However, if there comes a time when all the investments have gone in, $500 billion has been spent on data centers, and the returns that companies are earning on the AI investments that they have made have not lived up to scratch, then obviously what you're going to get is you're going to get a confluence, because the expectation is, of course, is that all of these AI investments are going to lift the economy. Now, if they don't, then obviously what will happen is the economy will be weaker as a result, and then consequently you will get a correction in artificial intelligence valuations, some of which I've been expecting for quite some time, but yet to materialize.
And thinking about AI and what it's yet to deliver, Richard, or what it can deliver in a sort of short time frame. I read a broker note this morning that was quoting a Fortune piece that quotes MIT, that has some research that shows that in MIT's research, only 5% of AI pilots are showing any kind of success rate early on. I mean, what are you looking at when it comes to getting a handle on the AI pilots and what they're able to deliver? Because there's so much hype and we really need to understand what it's delivering.
Exactly. That report is actually, in my opinion, is the reason why we saw the stock wobble, the market wobble yesterday. Now, interestingly, the headline, it looks terrible. But actually, when you dig into it, what you actually find is that the reason why 95% of the pilots have not delivered any sort of tangible benefit yet is because they haven't been implemented properly. The general expectation is that if I have a worker and I give him ChatGPT, then suddenly his productivity is going to increase tenfold. The real answer is, if you look at what these AI systems are really, really good at, is they're really great at ingesting vast amounts of data from all over the place, cross-referencing, and then being able to surface it in an easy-to-use way. The problem with that is that if I'm a company and I get a generative AI, I've got to train it on my data before it's really useful. And that's where the mismatch is. And if you delve a little bit deeper into the report, that's effectively what you see where the main reason why you haven't seen these returns yet. What I think that means is that you need these companies, they need to actually implement the AIs properly and target them in the wrong place. At the moment, if you speak to, many companies have said historically, yes, we must do generative AI, but we're not quite sure how we're going to use it. Once you get past that, and there are a number of use cases, then I suspect you'll start to see the kind of returns that one would hope for.
And does that keep the train on the tracks? And is that what we're going to see effectively in the Nvidia numbers coming up? What are you expecting from the Nvidia numbers? It's the last kind of big piece of the puzzle that we're looking for in the near term.
I think you're going to see a steady numbers from Nvidia. The beauty thing about Nvidia is that effectively they're sold out about 12 months in advance. Now, what that means is that their revenues is simply a factor of how much capacity they've booked at TSMC 12 months forward. And in turn, I think that gives them very, very good visibility at the moment. And so consequently, I think what you're going to see, there's been a very careful management of expectations over there. The guidance that they've set, I think what you'll see is the numbers will come out. They'll beat them a little bit, just enough to keep the train on the track. So, from that perspective, I'm not expecting any surprises from Nvidia at this point in time, simply because at the moment demand is so high, they've got great visibility.
Richard, thank you. Thanks for your time. Richard Windsor, founder and owner of Radio Free Mobile. We'll continue to track the tech sector. Nasdaq futures down by 0.4%. That's actually not as much as they were at the top of the hour, but we'll continue to watch that negativity around tech. Coming up on the programme, we'll be watching shares of the Swiss dairy giant Emmi this morning after the company boosted its organic sales forecast. We'll talk about that and other stocks that we are watching this morning. This is Bloomberg. Welcome back. This is the opening trade, 7:47 here in London. And the futures picture looks pretty negative, actually, for European stocks. So we are expecting some negativity at the start of trade. There's this tech theme, selling of big tech over in the US, which translates awkwardly into Europe sometimes. But we'll see where that takes us. We don't have a huge amount in terms of individual companies reporting this morning, so we'll watch for the big macro picture as we head towards Jackson Hole, Fed minutes later on today. Let us see what is on the mind of our Markets Live executive editor, Mark Cudmore, who joins us for 3 minutes on the markets. Mark, we were just talking to Richard Windsor about tech and about the tech sell-off we've seen and what drove that. I know on the Markets Live blog, you guys have been talking about how there wasn't much of a catalyst. Some people have attributed this MIT report and a write-up of it that suggests that AI projects and pilots are not very successful. What are you looking at in terms of this sell-off in tech and how sustained it will be?
I think it makes complete sense. We talked about this in the show on Monday, that we suddenly came into this week and AI was suddenly looking very vulnerable, specifically AI, after not being the weak link for the last few years. And I think, obviously valuations are stretched, but that's never a timing tool. But we've come into a period of where it's seasonally not great for the retail sector. There's been a big buyer of these mega cap tech names. But the really big catalyst on the horizon is, of course, Jackson Hole. And the bias for the next month, out of maybe not immediate reaction at Jackson Hole, but a delayed reaction at Jackson Hole or immediately, will be higher long end yields. And that's when AI is much higher duration asset than it was previously because of its capex cycle. So we've got a hype cycle that's extended relative to the impact cycle. We've got retail participation down just seasonally. We've got Jackson Hole on the horizon. We've got Nvidia earnings that are priced wonderfully, and they will be wonderful. They'll be absolutely wonderful. We know that all the AI earnings have been really strong this month, so that's already fully priced. They'll do great next week, and still the AI sector will sell off. I do expect this to be extended. I expect the next month to be very tough for AI. It's something we talked about already on the show this week, and I think that's going to be weigh on risk sentiment everywhere because we've got such a concentration of risk there. And it's not just about Jackson Hole. Remember, we've got potentially chip tariffs on the horizon, and we've also got the US administration taking revenues directly from some of the big names in this sector. Nvidia and AMD have already been targeted, but the White House announced last week they're looking to expand that revenue sharing idea, which means this is a chunk of profits being taken directly from companies.
Mark, is Powell going to flatten the curve?
I don't think so, particularly. I'll say that there's two ways we go this way. Let's simplify it, right? So either he validates the dovish pricing, and then the reaction will be, oh my God, he's folding to administration pressure, and you'll see a twist steepening. You'll see the front end come down and the long end rise. Now, the alternative is that he emphasizes that, hey, we've got a supply side problem in the labor market because the immigration crackdown, and therefore you respond with rate cuts to a supply side problem. That's not going to solve the labor issue, and hey, we've got a big inflation problem. And that would ultimately see a short-term flattening, but it'd be a bearish flattening. We'll see front-end yields jump. It won't see long-end yields kind of come down too much. And that's because the backdrop picture is everyone knows as soon as he pushes back on rate pricing, the administration will double down on pressure because of Powell's intransigence. And that means that all we do is see a delayed twist steepening from a higher level. So if he is hawkish, you actually see higher yields just move higher later, but in a much more powerful fashion. Either way, yields are going higher over the next month.
It's interesting, the administration's already getting its reaction in early, indicating massive rate cuts are coming. That, according to the president, that certainly seems to be the indication going into Jackson Hole, just to kind of set the tone. Mark, great stuff. Thank you very much indeed. Mark Cudmore, our executive editor for Markets Live. MLIV is the function, of course, you now know that, on your Bloomberg terminal. Stocks to watch this morning. We're talking about seafood, salmon. Chloe.
Yes, good morning, guys. So, let's start with something a little bit different today, and we are indeed talking about fish and salmon in particular. We got results from two salmon companies this morning, Mowi and Leroy Seafood Group. Both of them said that the harvest was really good at the moment, and Mowi even upgraded its forecast for the harvest for this year. But salmon prices are coming down a little bit, so we might see some weakness feeding through there. Both of those companies have been moving in tandem, as we can see here, and they're currently on the up. So we'll see how those latest updates kind of change the picture at the open. Moving on, but staying in food, we're talking about Emmi, which is a Swiss dairy producer. So it raised its sales guidance this morning. That might provide a bit of a boost. We are seeing a little bit of weakness. We're down about 1.6% year to date. And what's really interesting there is that the demand for high protein products, natural products, healthy products was really what drove this sales boost this morning. So definitely a trend to keep an eye on for dairy producers, but also meat producers as well. And then finally, let's end on a little bit of a more well-known stock, perhaps, LVMH, which got downgraded this morning by CICC. And we have seen already so much weakness in the shares. We're down 22% year to date. So we might see a little bit of further weakness there. In terms of what the analysts are saying, we are still at the majority of buys, but quite a lot of holds. And so that really indicates there's a lack of clarity going forward with all the tariff uncertainty and that weak consumer sentiment that is really holding back that luxury sector at the moment.
Chloe, thank you very much. Our equities reporter, Chloe Mellie. Now, it falls to me to make some unlikely pivots from the luxury that is LVMH to Labubu dolls. The Chinese toy maker has reported robust revenue and profit growth, boosted by high demand for its Labubu dolls. There they are. Apparently, the CEO has now said that mini Labubus are going to be available. And we mentioned this because the share price of Mart, which makes these, has soared, Guy, 11%. Is that soaring? I'm not sure that's soaring. But anyway, it's risen 11%. I'm not sure if these are... will they put people off their breakfast? We did have some
net profit is up 400%. This is a company that's now worth more than Hasbro.
I'd say that's soaring.
Hasbro, it's worth more than Hasbro and Mattel combined. I guess the link maybe to LVMH is you could probably attach the Labubu to your LVMH handbag. I don't know which would be worth more and which would cost more to... Yeah, I'm sure that's what people are doing right now. Of course they are.
Guy shows incredible insight.
I can read, basically. These toys apparently are sold in a blind box format. You don't know what you're going to get. So this reminds me of kind of football cards. You don't know what you're going to get, so you've got to go and buy another packet, so you've got to fill out the book, so you've got to get what you want. But, yeah, this is a frenzy. I'm trying to think of a parallel in the stock market.
Well, I don't know, but I'm thinking about a link into geopolitics. I mean, these are made in China, and they're a big hit in the United States. Does President Trump know about the popularity of Labubu? Does Scott Bessent know?
I'm sure he does, because he's talking about the amazing revenue that's coming in from China. Maybe this is where we're seeing that coming from.
OK, coming up on the programme, we'll bring you the opening trade, Labubus and everything. 7:54 here in London, so 6 minutes until we see the start of equity trading. Tech will no doubt hang over the trading day today. This is Bloomberg.
Wednesday the 20th, good morning. Europe has a little gap to fill in terms of where we are expecting equities to open this morning. This was the picture yesterday, coming into the end of the session, up, 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 up. But then the US had a different story, down, 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 as you can see. That was the tech sell-off. And as a result of which, we've got to price that in first thing this morning. That means you have this chart, or these series of charts, not charts, numbers, to look at this morning in the form of European futures. The Stoxx 50 down by 0.6%. The FTSE, very little tech in the FTSE 100. Bit of a problem, but not today. Only down by 0.2%. The DAX futures, though, a little bit more tech with names like SAP, down by nearly 0.8%. So that'll be the opening trade this morning. Where we go from there, I think probably remains to be seen as we price towards what is going to happen in Jackson Hole a little later on this week, Anna.
Yeah, absolutely. How quickly will we be able to move on from the tech selling? Well, US futures suggest that continues to be a theme, and so we have put this in our stocks to watch this morning here in Europe, because as you point out, Guy, there's some catch-up to be done with the US session of yesterday. So we'll watch those tech stocks. As I said earlier, the read across from the big tech, the mega caps in the US is a little awkward into Europe, but we will look to see if there's any weakness, and Nasdaq futures do point down by 0.3%. UK stocks could be in focus. We haven't seen a huge amount of reaction in the pound as a result of that inflation print. It came in hotter than expected. We got that 5% services inflation number. We'll watch for the gilt market open, which could be interesting to keep an eye on in terms of where we go there. We didn't see a huge amount of reaction to all the stories about taxation of the property market yesterday. It feels as if maybe the London market is on holiday right now. Alcon is in focus, the eye care business. That company out with some further guidance for the markets, Guy.
Absolutely. Airfares may be the reason for the CPI print today. Do they drop out? That's the story, it seems, this morning. OK, here we go. Equities, what are we going to see? How low do we go? This is the picture that we're looking at first thing this morning. Got a FTSE 100. Park the FTSE 100. It doesn't really have a tech effect into it, which is going to work today for the FTSE 100. We'll wait for the German market, which could take a little while to get going this morning. But the Stoxx 600, yet to get everything in and pricing and moving, so we don't really pay attention to that at the moment. The IBEX, though, is down by 0.3%, so a little bit of weakness coming through there. We are going to watch. The main event today, basically, is the DAX. And for those regular viewers, they know that the DAX takes a little while to get open. So we've got the CAC down by 0.4%. A downside move, but not a big downside move. Let's see how SAP opens. Let's see how Infineon opens. Let's see how some of these big tech names open in the DAX this morning. We will wait and see what that looks like in just a moment. So let's look at sectors. Let's look at individual stocks. What do you got, Anna?
Yeah, well, we do have some of those stocks that are open in the tech sector are weaker. So the technology sector is one of the sectors that is to the downside. downside, down by around 0.4%. And I can see that we've got things like Infineon and ASM International that are down by more than 1%. So there is some negativity around tech. It's not the worst performing sector, though. That still goes to industrial goods and services. We were talking about this sector yesterday with a particular focus on the defence names. And again, we see some weakness in defence. So Leonardo and BAE Systems and Thales all down by more than 1.5%, as is Saab. So we do have, again, another focus on defence. Even though we don't have a huge amount of news on the Ukraine front, we're still waiting to find out whether we get a meeting between Presidents Putin and Zelensky. Where will that be? Perhaps Budapest. But a lot of news lines being explored, but no great sort of revelations there. But still, a bit of weakness in the defence space this morning. Personal consumer, discretionary and grocery stores is the best performing sector.
Lots of inflation.
Up by 2%.
Lots of inflation in the food space. Pricing power certainly seems to still exist in that space at the moment. SAP's not open, Rheinmetall's not open, MTU Aero Engines not open, Siemens not open. These are the stocks that are the reason for the DAX not being open at this point. I'm interested to see what Rheinmetall does on the back of what Anna's just said in terms of what we're seeing in the defence space. It's hard. Are we moving towards peace seems to be the narrative, and we're watching that quite carefully. Still don't have a price on SAP. I think we're about to get one, though. So we're going to see some of these stocks open. Rheinmetall is down by nearly 5% or 4.5% at the moment. SAP is now open, but it's only down by 1.1%. So maybe not the big downside move that we were expecting. Actually, that's probably in line with what we've seen in terms of the story out of the States.
OK, so we are responding to that US tech sell-off then. We do see some weakness in tech, and we see another day of focus on defence stocks going lower, just at the margin, not giving up all their gains of the year, of course, but we are seeing a little bit of negativity there on the back of the positivity around what could develop in Ukraine. Let's talk about the big picture, though, as we move towards the Jackson Hole Symposium over in Wyoming. Mark Andersen joins us, co-head of Global Asset Allocation at UBS Wealth Management. Mark, very good to have you with us. And I mentioned Jackson Hole because you remind us in our notes that markets are still pricing in a roughly 90% chance that the Fed will cut at its upcoming meeting in September. That's a pretty high percentage. Do you think that is misplaced? Because that is one of the key things that seems to be underpinning the strength of stocks, give or take some tech sell-off here or there.
I think you're absolutely right that underpinning global equity markets and technology in particular over the last 3 to 6 months has certainly been this expectation that central banks, driven by the U.S. Federal Reserve, are likely to cut interest rates. And we certainly have 100 basis points of cuts until mid of next year from the Fed. We think they're likely to kick that off in around 4 weeks' time as well. It's still a little bit of a nervous time for markets because we have Jackson Hole coming up, and I think a lot of people are sort of hoping for Chair Powell to sort of lean into that cutting cycle. But with some producer price indices that have come in a little higher, I think he's unlikely to give sort of an all clear for a cut next month because we are still 4 weeks away from that meeting. He has a lot of discussions to be had before they're going to make that decision.
OK. So, Mark, so you're pricing in, like many others, quite a lot of cutting then from the Federal Reserve over the next 12 months or so. If we see all of those cuts come through from the Fed, do stocks go higher or do stocks go lower? Because we were having this debate yesterday. Stocks could go lower because maybe this cutting is driven by weakness in the US economy. Or they could go higher because, obviously, markets tend to like cuts in interest rates. So what are you thinking about the link between Fed policy and stocks?
I think our historical analysis suggests that when the Fed is cutting into something which is simply a slowdown, but not really a more dramatic slowdown call into sort of recession-like territory, stock markets are likely to respond very positively to that. And I think a lot of people are seeing some of the weakness in the U.S. labor market as an early indication that companies are unwilling to hire. That's certainly what we've seen with a 3-month average of payroll rises of 64,000, down from around 150,000, clearly in a below-trend type of growth environment. But the unemployment rate is not ticking up. We're still seeing very solid average hourly earnings, meaning that there is still a consumer that's likely to keep spending at a decent clip here. So we think that stock markets are going to respond very positively to these rate cuts, as long as it's not going to be a U.S. and global economy that falls apart. And there's still plenty of room to be cutting from here.
Mark, good morning. Should your clients be buying the dip in tech after the sell-off we saw yesterday and the ongoing dip we're seeing in European defence names?
Yeah, so we lean still in on the bullish side when it comes to AI. I'm not going to lie on that. Growth assets, long duration assets, they tend to like Fed cutting interest rates. We think they're going to do the same this time around. When we look at technology, it's still the sector that we expect to see very close to a 20% earnings growth from this year, outpacing by far most of the other sectors that we are covering. It's very clear at the moment. It is a little bit of an uncertain time just because we have Jackson Hole coming up with that very important sort of rate setting guidance. We also have Nvidia coming up next week as well. So that's a little bit of an uncertainty at a time where valuations seem to get on the stretch side. So no, we still like it, guys, to come to the conclusion here.
Okay. You say, as you say, long duration assets, they respond to what happens at interest rates. That's fine. Short-end yields are going potentially going to go lower if the Fed does cut, and you're right on that front. But long-end yields are doing the exact opposite right now, Mark. The curve is steepening. I've got a US 30-year that's north of 5%. I've got a US 10-year that's pushing higher as well in terms of the yield. Shouldn't that be a negative for tech stocks?
That would be a negative for tech stocks. So what we're expecting is that the long end of the curve will start to come down as we start to see those cuts coming in as well. So if we look at something at the US 10-year point, which is currently yielding at around 4.3%, we expect that to come down to around 4%. We expect the 30-year to rally from current levels close to 5% as well. So we think that there is an opportunity here in tech names, both from the sort of the cutting cycle, but also earnings that are still well on track. I think what is happening with sort of this unhinging of the long end of the curve is certainly uncertainty around inflation expectations. Again, we saw these producer prices coming up. Inflation expectations in the Michigan survey were sort of moving upwards again. Stephen Moran coming in on the Fed eventually. This Fed independent story is something that makes markets a bit nervous, but I don't think it's going to change sort of the overall course of the Fed. And ultimately, we think that long end yields are going to be driven by the short end as we usually see.
And Mark, how are you disaggregating the tech sector in the United States right now? Because, of course, there's the likes of Nvidia and those that have led the AI enthusiasm trade. And then there are those you might deem to be AI laggards, but still exposed to that trend. How are you separating the two, and over what kind of timeframes?
That's a good question. So we've very much, in this early phase over the last 1-2 years, focused very much on the enablers, of be it sort of the chip makers and the like. At the moment, we tend to focus a bit in around some of the more defensive names with sort of more stable earnings growth. I think as we're moving out over the next 1 to 2 years, we're going to see more of the sort of applications or the usage of AI that's going to be exciting. So I think this is a journey that has started where we're still in the early innings of this game. So when we look at the surveys that are being conducted within US firms, how many have really adopted AI? We're not even at 10% yet. So I think, again, we're in the very early days. There's still a long game to be played, and we're trying to stay on top of this as one of our core investment themes that we guide our clients towards in our multi-asset portfolios is something that we continue to like.
Mark, how are you thinking about the peace process, the attempts at a peace process around Ukraine? We've got another day where defence stocks are going weaker, and that's easy to understand if people really do see that these conversations between global leaders could lead to peace. How are you thinking about a peace dividend for Europe?
So we are certainly hopeful, as many others are, and we're happy to see some of these discussions that are currently ongoing. I'd say we're also realistic probably to say that we don't think we're going to see a peace deal by the end of this year, and we would not be surprised to see that some of the fighting continues into next year. And as much as we are hoping for that peace as everybody else, I think what we have witnessed over the last few months and quarters is still two sides that appear to be a bit too far away to really come to that agreement. But we're certainly hopeful. We think in terms of defense spending, when we look at the European Union and where we're going to see some of that government money will be flowing over the next couple of years, there's no doubt that defense is certainly one of those areas, and there's going to be both benefits within sort of the big listed stocks that we know very well and that you speak on here. But we think that there is a whole game to be played around some of the, say, younger unlisted company in that tech space that can do things around drones and similar sort of the new areas of warfare that we think has loads of potential in it as well over several years here.
So, Mark, just to come back to my earlier question, we talked about tech and buying the dip. Rheinmetall's down by 14% over the last 10 days. Again, you would buy that dip. Would that be the trend that you would continue to look for, an opportunity to get into that defence narrative?
So we typically don't go out and then say, let's just buy this one stock here. Defence is definitely one of the areas that when we like within the European equity space. It's very clear after the rally that we've seen year to date, these are also stocks that are very hyped, and we've seen a strong concentration in few individual names in Europe, where Europe as sort of defense sector maybe has not been as strong as we've seen in other countries. So I think there's been some rotation, obviously, out of defense when we've seen some of those peace talks advance. It says we like to go into defense as a bit more of a diversified manner, and both look at sort of listed as well as unlisted stocks here, and in the unlisted space where we're seeing maybe some of the more stronger technological advancements that I think is very exciting around this sector as well.
Mark, great to catch up. Useful insight, interesting insight. Mark Andersen, co-head of Global Asset Allocation, joining us from UBS Wealth Management. As I bring up what is happening in the defence space, let's show you what is happening in the core six. We have Rheinmetall down by 2.5%. The rest of the space is under pressure as well. Tech is also, as you can see, softer today. But let's start with the defence theme with Chloe. What else you got?
Good morning, guys. So we've seen, again, some weakness in defence stocks. It's a bit of a deja vu from yesterday, where I was stood in front of the same board that was also all in red yesterday. There's not that many more news coming through, as you mentioned earlier, but there seems to be this narrative of potential peace in Ukraine taking hold and leading to some weakness in those defence shares. So Rheinmetall, Hensoldt, Leonardo, BAE, all of them down this morning. Moving on to the tech sector, where we can see some negative read across from the tech sell-off, where we saw huge share drops in Nvidia or Intel, for example, and that is feeding through to some weakness in European tech names, including Infineon, ASM, STMicro, in more of that semiconductor space, but also a little bit of weakness in SAP, the software giant. Moving on to K+S, which is a fertilizer maker for the agricultural sector. It got downgraded at Berenberg, which said that the expectation for lower prices for 2026 were going to put pressure on that company. It is down 3.2% off the back of that downgrade. And finally, let's check in on our seafood stocks. So there were actually three. We talked about Mowi and Leroy, but Osterwald was also reporting today, and this is the one that did the worst, and the second quarter earnings really disappointed, and so we are down 3.5%. A little bit of weakness in Leroy as well, and Mowi, because of the upgraded harvest forecast, is seeming to hold up a little bit better. So it's not all good news for that salmon production business, it seems.
OK. Chloe, thank you very much. 8:13 in the morning here. Perfect time to be talking about seafood. Chloe Mellie from our equities team, thank you. Perhaps we'll stick with the food theme, because we're going to talk UK inflation next. UK inflation rising faster than expected in July, adding pressure on the Bank of England perhaps to reconsider its pace of rate cuts. We will discuss what to expect from the BOE. That's next. This is Bloomberg.
This week, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for continuing coverage leading up to a special episode of Surveillance, Friday at 9 a.m.
Grace Moose pictures on that video, on that promo. Massive. Anyway, Jackson Hole coming up. Cowboy hats, moose at the ready. Let's show you what's happening in terms of the numbers this morning. As you can see, a little bit of weakness in European stocks. The DAX is under quite a lot of pressure. Tech is down, but you've also got defence stocks down quite sharply as well. Both of those two combining to deliver a bigger blow to the German market. Let's talk about what is happening over in Spain. The country tackling several major wildfires, which are ongoing. The country's this season is one of the most destructive that we've seen in recent decades. Temperatures are beginning to roll off. That happened in Portugal first. Now it's beginning to happen in Spain as well. But we have seen, obviously, fires across the entire Iberian Peninsula. Sofia Horta y Costa joins us now from Lisbon. Portugal, Spain have been suffering, and the numbers are just mind-boggling here, Sophia, in terms of the scale of the fires that we are seeing. Spain seeing fires that have destroyed land, destroyed territory, twice the size of London. Just put this in context for us. How bad is this?
So in terms of area burnt, it's shaping out to be one of the worst years since records began. In Portugal, yesterday, one of the fires was spreading, and it was, in terms of area burnt, the largest fire ever recorded in Portugal. The problem here, Guy, is that we had a very wet spring, a very wet winter as well, which is quite unusual for Spain and Portugal. And then a very, very hot, dry summer that's extending these kind of heat waves. This is the fourth heat wave that the area is suffering. So those conditions have really made it worse. And even though temperatures are dropping in the Iberian Peninsula, the problem, Guy, is that the wind is picking up. So in Portugal, one of the fires is spreading very, very quickly. Right now, we have more than 1,500 firefighters at the scene. One person was critically injured yesterday. So it doesn't seem like it's going to let up anytime soon, which was the hope for this week when temperatures drop and humidity picked up.
Yeah, Sophia, what kind of pressure then are the governments of both of these countries under as people continue to deal with these fires?
Yeah, so it's a very sensitive political issue, especially in Portugal since 2017, when more than 120 people died. And the problem, Anna, is that the regions that are facing these wildfires this year are in exactly the same regions as that time. So the Portuguese Prime Minister is under a lot of pressure to do more. He hadn't yet visited the affected areas. He finally did yesterday. He went to the funeral of one firefighter who had passed away on his way to the scene. And also in Spain, Sanchez facing a lot of pressure to do more. Now, Sanchez actually called for European help earlier than his Portuguese counterparts. It's the largest international assistance for wildfires that Spain has ever seen. The Portuguese PM is facing criticism that he didn't do that sooner. He did cancel his summer holidays, but he only did that after a party conference in the Algarve in the south of Portugal. So he's facing pressure to do more. And one of the parties here, the far-right Chega party, is going further and pressuring for the interior minister to resign. So you can see it's a really hot-button issue, both in Portugal and Spain, for politicians to do more to prevent this, because it does happen every single year.
Sophia, to that point, is there now a growing sense that this could actually impact the economy, that we could see a read across into tourism, that people aren't going to be going to these countries in the high season that they normally would, that people go at later on in the year? I'm wondering how this feeds through into the data. Obviously, this clearly is going to affect things short term, but is there a longer term story here as well?
There is. I mean, a lot of the fires are not in the hotspots of the tourism. This is in rural areas mainly. But the flip side to that is places like the Algarve, like Ibiza, have heat warnings, and this means, you can't. There's a lot of activities that you can't do, a lot of restrictions. But also the optics of it all. I mean, if people see these countries burning, and also the summer season is getting longer and longer because temperatures are getting higher in what was before the shoulder seasons of spring and autumn. It means there's more pressure on resources. Water resources are depleting in Spain. You actually have less space because you have rising sea levels. So you are seeing the long-term impact of not just climate change, and obviously wildfires are a feature of that, but also the increasingly long tourism season. We've yet to see that in the numbers because people still come, but rising temperatures, and also remember, Guy, air conditioning is not really popular in many parts of Portugal and Spain, so that does also deter tourists who, say they're just not comfortable in these incredibly intense temperatures. Again, it is. We've yet to see the impact on the hotspots in the Algarve. We're not seeing fires there, thankfully, but it is an area of concern.
Sophia, thank you very much. Bloomberg's Lisbon Bureau Chief Sophia Horta-Acosta joining us with an update there on those wildfires. Back to the UK now, and the inflation story that we've covered already this morning, climbing for a second month in July, adding pressure on the Bank of England to reconsider its pace of interest rate cuts. Joining us now, Bloomberg's Morwenna Coniam with details. So your key takeaways then, we've had an hour and 23 minutes to digest all the details. We went through some of them earlier in the programme. Your key takeaways from this CPI reading seemed, at first glance, hotter than had been anticipated.
Yeah, I mean, really, across the board in most categories, we did see inflation accelerating, particularly the services figure. It was more than economists expected, and I think that's the key thing, that we'd expected things to accelerate in general, but this was more than people had been expecting. That is going to be a concern for the Bank of England, and particularly some of the stickier areas like services, which makes up 80% of the UK economy. That's one of the reasons why the Bank of England was hesitant to begin its cycle of interest rate cuts last year, because the services sector inflation had proved more sticky. So that's going to be a concern. And we've also seen things like, jobs data and GDP coming through to suggest that maybe these cuts aren't quite so urgent. So we've seen traders consequently paring back their bets this morning on further rate cuts from the Bank of England. We're now only seeing about a 40% chance of another one this year. We're really looking at the first quarter of next year for there to be another 25 basis point cut seen. So that would be a slowing down of the pace than had been expected earlier this year.
Isn't an argument for just looking through this data? Airfares are up. School holiday timing, always a factor. This time round, it seems like it's been more extreme. So you've got a 15%, whatever it is, on airfares. I can look through that number. That's going to drop out really quickly. I can blame Oasis, maybe. You're seeing concert tickets up really quite sharply. Marmalade prices, I think, are a whole separate issue.
That's a much more worrying dynamic for Guy.
Much more concerning. Chocolate prices also, for my wife. But the headline number seems to have been driven a lot by airfares. And isn't the bank just going to go, that's going to drop out, I'm more worried about the labour market, that's where our concern should be?
I think you're right. There are some costs there that will be transitory. Airfares is certainly one that can be quite volatile, although it's frequently been mentioned as one of the driving factors, so it seems to be more of a trend than a one-off. And that's also driven by higher fuel prices as well. So there's actually a geopolitical dimension there, I think, and that's something which, depending on what happens in Russia and Ukraine, we might see changes there. But the food cost inflation is important because it does feed through into how much money people feel like they have and how much money they do have on a monthly basis. That then drives demand for wage increases. And what we have seen as well is those costs in accommodation services and restaurants, that's driven through by those higher wages too, and those are hard to reverse.
Morwenna, thank you very much. Morwenna Coniam with the latest on UK inflation. Coming up, we check in on the global trade and supply chain story amid Donald Trump's trade war. We'll be speaking to Mike Parra, the CEO of DHL Express Europe. That conversation next. This is Bloomberg. Welcome back, everybody. This is the opening trade, 30 minutes into today's session. Let's take stock then of where we are. And we see negativity across these markets, largely driven by a catch-up trade around technology. Industrial goods and services, though, having another day of negativity. So all of that plays out fairly weakly for the DAX and for the CAC Heron. The FTSE 100, less tech there, of course, and so is a bit more resilient. Broadly, then, we do see stocks weaker by around 0.25%, Guy. And we can ask how long this is maintained. If this is a tech sell-off, a Mag 7 sell-off over in the United States, then it's difficult to see that being sustained into Europe. But for the moment, we see that here, and we do see some selling in defence names as well. Another day of perhaps the market's thinking about what could happen in Ukraine.
So volume is quite light. What is it, August the 20th? We're mid-August, let's call it mid-August. A lot of people are on holiday, not a lot happening, you could argue, in terms of therefore trading, and you can see that reflected in the numbers. We're down by 52%, 53% in terms of the 100-day average. There are more stocks down than up, so yeah, the arithmetic is fairly straightforward. Obviously, that doesn't account for weightings, but we are definitely down. On my screen this morning, there are not many 52-week highs and lows, which again kind of speaks to the idea that actually markets are kind of not doing a lot at the moment. One stock that does stand out as a 52-week low is Alcon. That stock on a year basis is down by 22.35, and this morning squint and you'll see this. You're going to need some glasses or contact lenses or something potentially to see this, but it is down here. The stock has dropped quite sharply this morning on the back of what are being described as quite uninspiring numbers. Now, the bar was already pretty low going into these figures, so the fact that that bar has been a struggle to clear has been a little bit problematic for the analyst community this morning, and the stock has sold off fairly sharply. So that stock certainly won, and as I say, you need to squint to see it, but contact lenses may fix that, is where the story is this morning. Alcon down by 22.4% over 52 weeks, Anna.
Very nice. Right, here's some of the other stories that we're watching for today. We talked about UK inflation a bit on the programme, but let's get an update on some of the detail there. UK inflation climbed to an 18-month high last month on the back of surging fuel, food and transport prices. Consumer prices rose by 3.8% from a year earlier. That's up from 3.6%. That was the rate in June, and it's the fastest pace since January of 2024. The uptick puts the Bank of England under some pressure to reconsider perhaps the pace of interest rate cuts, although as we discussed, a lot coming from airfares and hotels, and maybe they prefer to look through that stuff. We'll continue to keep that under review. Now, Wall Street's summer calm has finally cracked as a sell-off in big tech dragged down stocks. Nvidia shares dropped by 3.5%, with Palantir slumping more than 9%. The move underscores the US market's narrow reliance on a handful of tech giants. And Scott Bessent has indicated the US is satisfied with the current tariff setup with China, a signal that perhaps the Trump administration is looking to maintain calm with its economic rival right now. The US Treasury Secretary told Fox News the administration is, quote, very happy with the situation and that the status quo with China is working pretty well.
Let's talk more about all of this and what is happening with that China story in a little bit more detail. Bloomberg News desk editor Jill Desis joining us on the story. What do I read in, Jill, to these comments that we're getting from Bessent? He made them on Fox yesterday talking about trade and where we go forward from here. He said that he's reasonably comfortable with the current picture and that revenue is very strong coming from those China tariffs. Does that tell us more about where actually the administration's objectives lie with these tariffs, i.e. revenue raising, than maybe reshaping global trade?
Well, Guy, what I would put these particular comments in the context of is this idea that we're still maybe paving the way for a potential meeting between Donald Trump and Xi Jinping. Kind of reads to me like, I'm not really sure whether Washington wants to rock the boat before that potential bilateral. So that's something that we could be seeing as soon as maybe the end of October, early November. That's when the APEC summit takes place in Seoul, South Korea. Maybe there's an opportunity for Trump and Xi to meet ahead of then or during then or just after then. And we've got now this trade truce between the U.S. and China that's not due to expire until just after that, around November 12th, I think is that deadline. So I think if you're looking in terms of just kind of stabilizing U.S.-China relations for the moment, not trying to ratchet up rhetoric as it was earlier this year when we were talking about 100%, 150% tariffs and all that kind of stuff, then just kind of keeping things as they are, maintaining the status quo may be the best opportunity for both of those nations to kind of just, again, pave that way for that potential leaders summit.
And President Trump does seem to be widening, though, the tariffs in some areas, metals tariffs, for example. What does that mean for global supply chains then, Jill?
Yes, well, Anna, I think what you're referring to there is just some recent, some information that we got sort of from the Customs Department looking at those steel and aluminum tariffs in particular. It seemed that at the end of last week, suddenly those seem to apply to a much broader array of goods, including a lot of consumer goods, motorcycles, that kind of thing, that seemed to catch some sort of logistics firms a bit off guard as to the fact that they didn't realize that those would necessarily be applying there. I think what that tells you is look, I mean, I think we've said this many, many times on this program and others, that trade agreements in general, before this year, I mean, typically took months, if not years, to sort of negotiate and try to figure out and everything like that. And now we've gone from a cadence where, you might see broad trade agreements take that long to ultimately come to fruition, to now the Trump administration has really tried to kickstart how exactly it handles tariffs and trade agreements. And a lot of these things are happening within weeks, if not days. And so it does kind of indicate that, obviously the tariff regime seems to be a bit bumpy as people kind of, get used to what exactly that looks like on a day-to-day basis.
Jill, thanks very much. Bloomberg's Jill Desis with the latest on the trade narrative. Let's stick with the trade theme and turn to one of the key players in the global logistics and express delivery industry, and that is DHL Group, of course. It reaches over 220 countries. Joining us now, DHL Express Europe's CEO, Mike Parra. Mike, nice to speak to you. Thank you so much for giving us your time this morning. So we were just hearing from Jill the latest instalments of the tariff drama and all of the news flow that comes along with that. It comes thick and fast. It changes all the time. How do you as a business manage? Have you had to change the way that you manage the business as a result of this fast-changing tariff environment?
Yeah, no, absolutely. First of all, thanks for having us. And absolutely, I mean, the volatility would be our key word that I would stay on, and that is we've seen nothing but volatility since the announcement in February, March, going into April timeframe, and now what's about to happen on the 29th of August when de minimis goes away in the U.S. So it's been a lot of complexity. And costs, which we can do well as an organization managing there. The area where we see the biggest risk is the volatility. So it's the change of tariff from one day to another, 25 to 50% for India, or the change in tariff for Brazil, as an example. I think one of the great things that we've seen is for the European Union, where I currently sit in, is the fact that the EU, albeit maybe a bit high, or people might see a bit low, at 15%, at least there's some stability there. Or the UK going in early and getting a 10% agreement from that perspective. So I also will say that when we look at the state of the business for us, we are seeing a shift in trade. And one of the words that we use as an organization is global trade is too big to fail. Global trade is too big to fail. And it's like water. It's going to find its lowest point. And there has been a shift in trade. So as an example, China-U.S. was a big trade lane for us. And Asia-Pacific to U.S. was a big trade lane for us. Well, now that's shifted to China and Asia-Pacific to Europe.
Yes.
So we have seen a shift in trade.
So too big to fail, but it's being reshaped right now under the US administration. We've just had some comments actually coming through from Christine Lagarde over at the ECB saying that recent trade deals have alleviated global uncertainty, but they haven't eliminated uncertainty. And I'm sure that reflects how a lot of CEOs around the world feel about the global environment right now. What do customers say to you? How do they manage? How does that look to you, that level of uncertainty that they're dealing with at this point?
Sure. The feedback we're getting from customers can almost fit in a couple of buckets. One of them, as we were talking offset, is they're in this wait-and-see mode. They're going to wait and see what happens on the 29th of August, as an example, when de minimis goes away. We have customers that are coming to us and saying, DHL, you're in 219 countries across the world. Help us to go global to other countries. So we're looking at markets like Latin America. From Europe, as an example. We're also taking a look at growth that we're seeing in Eastern Europe, whether it be Poland or Hungary or Czech, where we're seeing foreign direct investment that's taking place there, and we're calling that the GT20, what we're calling our geographical tailwinds. And that is markets that we see, top 20 countries globally that we see growth in. So customers are saying to us, how do you help us to go international? How do you help us to shift some of our business from the U.S. and go to other markets from that perspective?
You said a moment ago that you're seeing a shift from Asia to U.S. to Asia to Europe.
Yes.
The fear was going into all of this was that we would see deflation in Europe because we're going to see more goods arriving in Europe as a result of the fact they're not going to the United States. Can you give me a sense of the scale of the shift that we're seeing there?
Yeah, it's gradual, I would say. So it's not an onslaught where we're overwhelmed with the volume that's coming in, but we are seeing growth. But we're also seeing growth in Europe. I mean, Germany, we're seeing growth in Germany that's happening, which is normally a good indicator for us in Europe of what's going to happen. We're seeing the PMI index in Europe that's almost at 50 from a low of mid-40s. Now is almost at 50, which is a good indicator for us. We did see some front loading in March that took place across the world, but more specifically into the U.S. and some of it as well. But what we've seen is a steady flow of increase coming into Europe from that perspective.
Just back to that US point. How far through that do you think we are? Was there a kind of, you saw front loading and then people stopped?
Yeah.
Are they back ordering again? Is that inventory being used? Inventory is not being used up, you would suggest?
Well, we saw some front loading in the month of March, and then it slowed down April, May, June, and July. And I think what's happening here, going back to the volatility, is what's going to happen after the 29th of August once de minimis goes away.
How big is that? Is it just a hard stop when de minimis goes away?
Absolutely. 12:01 on the 29th of August, de minimis in the U.S. is gone. And that will be one of the things for us is we're prepared for it. So we've hired extra resources in the area of customs processing. We were talking about all the changes in tariffs on a daily basis. How do we keep up with it? It's ever changing every single day. And as it happens, we update our systems, we update our customers. And a lot of our customers, well, you got to think about 90% of our active account customer base are small to medium-sized enterprises who don't have a lot of resources that can get this information. So they rely on an organization like DHL to be able to provide that to them and also help them to go international to other key locations.
How big a driver of volumes or whatever metric you want to think about, Mike, were things like are things like de minimis? I mean, how much business was that creating for a business like DHL? And I ask this in the US context because we know that's going away, but also, you know, politically, a lot of politicians around Europe will be watching this and possibly asking themselves questions about whether they want to change the regime in Europe. The rules are very different, but they exist in other forms in Europe as well.
Absolutely. I had a feeling that question would come up in some way, shape, or form. We did see a drop in business going into the U.S. So if anybody would say, have you seen a drop from your China, Asia Pacific business, or even Europe going into the U.S.? Yeah, we have seen a drop, double-digit drop, which we've publicly already shared. So I would say if they're thinking about eliminating de minimis, they have the right to do that. We would obviously advocate and share the customer opinions of eliminating a de minimis, let's say here in the UK, as an example, which is up for discussion. We would advocate it and share our feedback, but at the end of the day, we're not policymakers. We'll follow the policy and we'll make sure that we inform our customers appropriately. But there has been a drop.
Mike, I'm sure you're using AI.
Yes.
Given what is going on and the volatility that you're seeing, I'm sure you're trying to use it as effectively as you possibly can. How effective is it? You're a business that would seem an obvious choice to start to implement some of this technology. Bots communicating with customers. There's lots of ways of doing it. How effective is it right now? What kind of rate of return are you getting off the investment maybe you're making? Where do you see the opportunity? Is all the hype justified in terms of what you're seeing?
Yeah, for us, I would say we continue to grow in that space and have been in that space for some time now.
Sure.
One of the areas that we're looking at deploying agentic AI as an example is in the area of customs, where we can work up front through AI to leverage it and then redeploy and upskill our employees that are currently in that area and put them in other areas where they can help our customers who are calling in and saying, can you help me on this change in tariff? What does it mean? Can you tell me what an HTS code is and how do I apply it?
Right.
Can you tell me what the landed duty and taxes will be? Hey, can you help me with the appropriate Incoterm that I want to use going into the U.S., whether it's delivery duty taxes unpaid or delivery duty taxes paid? So we're using AI now on areas where we can interact with customers, and then we take the individuals that we're doing that and we upskill them and redeploy them in other areas.
But is the hype?
It's real.
It's real? It's
It is
justified?
real.
You think this is going to be transformative in terms of your business?
Absolutely. It's going to help us in the space of customer service.
Okay.
It's going to help us in the space of customs. Absolutely.
Great to catch up, Mike. Thanks for stopping by to see us.
Thank you.
You're a busy man. Mike Parra, DHL Express Europe CEO. Thank you very much indeed. Coming up, we're going to turn back to what it's seeing in the geopolitical front. European leaders look to offer troops as a Ukraine security package begins to take shape. We're maybe talking about air cover from the Americans as well. All of these details, we'll give you more next. This is Bloomberg. 48 minutes past the hour. Welcome back. You're watching the opening trade. This is where markets are nearly 50 minutes into the session. As you can see, we are down, but not by that much. It is tech and defence that is causing the damage on the downside. Eye care as well, apparently. Alcon suffering as we see its numbers disappointing. Let's turn our attention to what is happening with the geopolitical story, though, which is impacting, you could argue, some of those defence names. A package of security guarantees for Ukraine is taking shape, with European leaders weighing sending troops as part of a potential peace deal. Ukraine's allies are hoping to strengthen Kyiv's position ahead of a potential meeting between President Putin and Zelensky. Let's talk to Bloomberg's Stephanie Baker, author of Punishing Putin: Inside the Global Economic War to Bring Down Russia. Security guarantees. Security guarantees could imply US air cover. The Journal's reporting that today. European boots on the ground in Ukraine in some shape or form. This is Putin sees this as Russian territory. This is NATO forces operating inside Ukraine. Is that something that's going to be acceptable in this Zelensky-Putin meeting that we could be talking about?
Well, I think the thinking is that any deal is only enforceable if there are these security guarantees. They're trying to hammer out the details. The devil is definitely in the details. You have the U.S. Joint Chief of Staff meeting with his British counterpart, Tony Radakin, today to try to pin that down. There is this talk of potential air cover. U.S. support, logistics and intelligence is absolutely crucial. But European countries haven't gotten together to commit enough forces on the ground. So that's a huge hurdle. And although coming out of the Alaska summit, Steve Witkoff, Trump's envoy, said that Putin had agreed to allow these sort of NATO Article 5-like guarantees, the statements coming out of the Kremlin are rejecting that, saying we do not accept the idea of any European troops from NATO countries in Ukraine. So there's a lot. We're very far off from any kind of firm agreement as to how exactly that's going to work and whether or not those security guarantees would be legally binding. I mean, because Ukraine had the Budapest Memorandum of 1994 after it gave up its nuclear weapons, and that was not legally binding and it didn't hold.
Yeah. I mean, we've seen 2 days then, Stephanie, since these meetings in Washington. We've seen 2 days where defence stocks have weakened across Europe, as if there are many market participants who are thinking that this could be material, but actually, we don't have a date for a meeting. We don't have confirmation from the Russian side yet that President Putin is prepared to meet Volodymyr Zelensky, or that they feel there's enough to meet to talk about. Is that the case? How likely is this meeting to take place?
Right. And out of the Alaska summit, Trump had proposed this Putin-Zelensky meeting and said that Putin had agreed to do it. And then, again, you get a different readout from the Kremlin saying a lot of preparation needs to go into that, and we think we need to just have some more senior negotiators meet first. So it looks like Putin is once again playing for time. He has called Zelensky an illegitimate leader. He has said that certain conditions need to be set up before he would meet with him. And those conditions is really doublespeak for Ukraine giving up territory. Yeah. And Zelensky has said he's not going to do that. So I think we're pretty far away from a bilateral meeting. And it does seem to me that Trump is basically saying, you guys go work it out. Yeah. And that's not going to end well.
Does Putin seem like he's ready to stop the war?
No, he doesn't seem like he's ready to stop the war at all. In fact, the Alaska summit was all about heading off tougher sanctions, playing for time because the Russian troops are on the up, on the ground in Ukraine. They're slowly gaining territory, but they're still nowhere near gaining control of the rest of Donetsk that it's demanded at negotiations. The UK defense estimate is that it would take them 4 years to take that.
Stephanie, thank you very much. Bloomberg's Stephanie Baker with the latest on Ukraine. Back to the macro picture as far as markets are concerned, and we're still waiting for some data. Today, we've got 10 a.m. UK time Euro area CPI. Expect it as a final reading, expected to come in at 2%, bang on the nose. Around 11:30 a.m. UK time, we'll get target earnings, an important reader perhaps on the US consumer. 4 p.m. UK, we get Waller speaking, the Fed's Waller, that is, of course, and FOMC minutes later on today. So plenty for Valerie Teitel to digest.
And she's just been whisked
she's been wheeled in
around the set to join us. Wheeled in. So what are we focusing on? Is it the retail earnings? Is it just what is happening in tech? Set the stage for us.
Look, I think there's two key themes today, one of which, does this weakness in tech persist? Because I think if it likely is to persist through today, the narrative is just going to be that no one is going to be around to buy the dip until we hear from Jackson Hole, until we hear from Fed Chair in Jackson Hole on Friday. The other really big thing, though, is retailer earnings. We had Home Depot yesterday, where their results showed that consumers were pulling back from big ticket items, and the CFO actually implied that they are running through their inventory and are likely going to have to increase prices on some of their goods in the last quarter of the year. So a bit of an inflation warning from Home Depot.
The stock went up.
The stock ended up in the green at the end of the day. Yes, it did fall down 5% after the immediate results from the earnings. We do have Target today and Walmart tomorrow. So really looking for a good picture on the U.S. consumer and how these companies are dealing with passing through price rises as well.
Yes, because, how much had they stocked up, and therefore there was a lot of inventory that doesn't have to respond to the tariffs just yet. All of that conversation, no doubt, very important. And that feeds us into the Fed conversation, doesn't it? Because how the US consumer is coping, how retailers are coping with the tariff environment, really crucial to the Fed's tone. Any change in your thinking on Jackson Hole, then, Valerie, and what we expect?
Look, Anna Wong, our own Bloomberg economist, wrote a great piece on the terminal talking about, in her mind, what is the hawkish scenario. And she penciled out this scenario where Jerome Powell pivots away from this monetary policy framework called flexible inflation targeting. And that could be seen as mildly hawkish. It was something that was really useful when inflation was below target, as a reason for them not to continue easing or continue cutting rates, which were also which were at zero at that time. It's not really been that useful now that inflation's been running above target.
To keep the White House on board, does he need to signal rate cuts? Does anything else generate a big response from the White? This is the question I think people are trying to work out, because it feels like the strings are being pulled by politics at the moment, which is percolating into the market. So kind of, do we? Is it what's more market moving, the Powell speech or the reaction to the speech from the White House?
Look, that's a good point, right? Who are we watching? Are we still watching Fed Chair Jerome Powell, or are we watching Chris Waller, who is speaking, later today? It's on Bitcoin and on cryptocurrency, so probably not monetary policy moving. But who do we watch now? If you're of the mind that Fed Chair Powell is not going to last through the remainder of the year, would it be Scott Bessent, who is in charge somewhat of the first round of Fed chair interviews, who has talked to Bloomberg even last week about the Fed needing to cut around 150 basis points? He's talked also around a major rate cut in September, around a 50 basis point rate cut. Or is it going to be Powell's speech, on Friday? If he some way opens the door for easing policy moving forward, if he concedes anything about the labor market not being as strong as he previously characterized.
Yeah, there could be some central bankers who might choose to hide behind some quite technical language if they're trying to fend off political pressure and to make the message a little more difficult to read, I suppose, or, available to the pros. But, Valerie, thank you very much. We'll continue to, of course, work our way towards Jackson Hole. Coming up on the programme, the CEO of Fortero, one of the UK's largest tech unicorns, will be on the pulse at 9:45 London time. So that keeps up the tech theme, one that we'll continue to watch as the day progresses.
Absolutely. Airfares are up. Marmalade prices are up as well. Ticket prices are up.
Oasis has a lot to answer for.
In so many ways. Anyway, that wraps things up. That was the UK inflation story. The opening trade is done. The pulse is next. This is Bloomberg.